Hey guys, welcome to Beyond Bricks. I am your host, Kevin Sorton. Guys, today I am pumped. I've got one of my great friends, my favorite loan officer. I've got James Taveggia here from Union Home Mortgage, and we're going to have a super cool conversation. I'm excited to see where it's going to go. So, James, welcome to the show. Excited to have you here.
Thanks, man. Feels good to be here. I appreciate it.
It's going to be fun. So, James, let's start with this. So, I want to go through a little bit of your background because you're one of the very few people I know. We're in an industry where, what, 5, 10 years is kind of how long the majority of people have been in.
Yeah, it's kind of a finicky thing because there isn't really necessarily like a training platform or a way to start. You just kind of figure out your way into this business one way or another. And yeah, they typically look for experience. They want a 5-year, 10-year for most institutions. They look at closing volume, those types.
How long have you been in them?
So June 4th of 2026 would mark a 21-year anniversary.
21 years. Because I was going to say, we're almost exactly the same amount of time because I crossed 20 years in August. So
Ages me.
yeah, we don't have to give our full age, but it's rare to come across and have two people sitting in a room that have 20 plus years experience. I mean, we're 2 decades in. We have seen a lot of things. And yeah, we both had a front row seat for 2008
Actual crash.
We got to watch that. We were there for it. We got to ride that train. We got to see it as it came back. We got to experience COVID. We got to experience all these different markets. And I think that, I mean, I could make the argument, I'm sure you would too, going through all that is part of what's made my career what it is.
100%, if not maybe sharpen the skills a little bit more. Because when you can make it through a market like that and still come out on top and be successful, I mean, we're the few and the brave, brother.
Well, yeah, exactly. Because most people in 2008 rolled out.
100%. I would say more than half our sales force disappeared. I mean, almost overnight. Yeah, it was very quick.
Very quick. So give us a little bit of your background. I know a good amount of it because Union Home is not your first rodeo.
No.
Right. This is where you're at now, and you're very happy and enjoying what you guys are doing there. You guys are doing some amazing things, not just from you as a team, but you guys as a company. I know you guys do some awesome things. But give me a little bit and give everybody out there a background a little bit into the story of James Taveggia and what brought you here.
Cool. I feel honored and special. So day one, mortgage, Rock Financial. So that would have been Quicken Loans, Michigan-based business, more referral-based. So I'm glad that that's the way that I was taught mortgage. Now, back when I started, they had a 30-day, very extensive training program. And so when you, quote unquote, graduated, you came out with a healthy amount of knowledge, but you really didn't know anything, right? You had some basic terms down.
It was a flat crash course.
Yep. Here's your laptop. Here's your desk. Start calling numbers.
He was enough to not sound stupid if somebody answered the phone.
Precisely. Yeah. Like I had a little bit more general education than the person that was walking into it. But it was a very different company back then. Rock Financial was amazing. I mean, some of the best years of my life. I remember my first commission check. So it was $8,300 gross, which was like the equivalent of almost $5,000 in an account at one time. I had never seen that.
You're like, oh my God.
Like, what is this mystery of money? Truth be told, I think at the time I was still smoking cigarettes and taking like the returnables back from my parents' house to get my pack of cigarettes. Like dead broke kind of deal.
Like eating ramen noodles on the couch, and that was all I could afford.
Yeah, more or less. Or my parents' ramen.
Yeah, that's because I'd be like, hey, my dad, can you hook me up?
Yeah.
Can I get $50 to go to the grocery store?
Seriously, that was my life until then. So you can imagine, right? To go through your training and then your first full month of production, and oh my gosh. So I obviously bought into it immediately because I had never seen that kind of money, and I was going to school full time at Walsh for a business degree in finance, and I just started working with Rock Financial. Everything worked, everything hit right, and the rest is history. 21 years later. But as far as like humble beginnings, I had a lot of guidance from some guys, Jason Hall, Matt Duffield. These were two absolute powerhouses in the mortgage industry at the time. They were both Rock Financial guys.
Still names that are well known.
Yeah, very, very good business.
In our industry, most people know those two names.
Yes. Yep. They've gravitated away from mortgage. doing maybe bigger and better things, but they were the beacon. They were the one that you wanted to be like. So I remember having conversations with them. Like they were celebrities at the time, and they really did help me out with just general sales knowledge, but more work ethic. I mean, those guys would, especially Jason. I mean, he lived at the office. So I definitely attest a lot of just my general knowledge, my initial introduction into sales to those guys. But I worked with Quicken for, well, Rock Quicken. So to be transparent or correct, I should say with what I'm saying. I worked with Rock for about 2.5 years, and then everyone was more or less forced to go over to Quicken.
Yep.
But I was with the company a total of 5.5 years, got the web-based internet style lead. So you kind of learn how to do the business two different ways. I left Quicken in December 2009. But yes, 2008, lived through that. Um, it was like one day we just got a phone call and all of the products that we were selling were no longer for sale.
It's funny. I don't get to talk to a lot of loan officers that were in the industry in 2008 because most of you didn't survive,
Yeah.
right? I had a lot of realtors that survived, but it was because when I came into the industry, I was the youngest person in my office by, let's see, Sue was older than me by maybe 10 years.
Okay.
After her, there's another 20-year gap to the next agent when I came in. So it's 2008. I'm in my early 20s, and I didn't know better, right? I still lived at home. I could figure it out, right? Like I didn't have major overhead. Yeah, well, I know I was in an office that had, I think, 90, almost over 100 agents in it, in Rochester.
Mm-hmm.
By the end of '08, 30, 40,
Yeah.
right? But there was a lot of the old timers that hung around that they weren't going anywhere. They had enough residual business, but even them, they were like, this is terrible.
Oh yeah.
What is happening? What was it like from the mortgage? Because your perspective, same thing. Like it was, we were in the ninja loan when I first got in. It's like, dude, you could just come in and say, I want to buy a house. I'd be like, cool, call this person.
Yeah.
We'll have you a house in 2 weeks. Like it was.
Yeah, you got a pulse and a heartbeat and a FICO score.
Yeah, you're
close
good.
and financing.
Yeah, if we can prove you're a citizen, let's fire up.
Yep.
Right. That's all. We didn't need much, and then all of a sudden we're like, oh wait, it's getting a little weird out here, and then we watched it just poof right off the cliff. What was that like from your perspective? What was the feeling around the office? And I'm guessing people just disappeared like crazy.
Yeah. So same thing. Mass exodus. Not everybody obviously was coming home per se. It was very similar to the experience that you had, not immediate, but very quickly the weeks, the months go by. And it was really just the restrictions that were put on lending. So everybody was considered declining market. And so now loan to values or equity position in layman's terms, like how much you were allowed to put down, that started becoming increased. You better have a 700 credit score and 6 months in reserves if you're trying to buy a home. It just literally got down to the point to where we had all of these different products, like you had said, no income, no assets, the Nina, stated income, stated assets. We had option arms, adjustable rate mortgages.
Yep.
All of these different, products that we used on a daily basis to service the client with different loan options are now out the door. So now you're literally down to 30-year fixed, 15-year if the client felt daring enough, right? Interest rates were not exactly amazing back then either. And the hardest part about that market is that people lost, theoretically, let's just say half their value almost overnight. So if you're at an adjustable rate mortgage at that time, you don't have the ability to refinance if you've bought within the past couple of years and you didn't have a large down payment.
Yeah, refi's out.
Trying to buy a new home, well, maybe 5% down at that time was the minimum down payment, but Michigan would have been considered a declining market. So they would have reduced, not reduced, but the equity position, like maybe you had to have an extra 5% down on top of it being a declining or soft market. So now your minimum down payment of 5% goes to 10%. And then at the same point in time, I don't think like the general consumer in the real estate market truly realized how quick things had gone south. So then you're fighting against appraisals and homes coming in, exponentially lower than what they're trying to sell the home for, even though they pay significantly more for the house that they're trying to sell right now, X amount of years ago. So it really had an impact financially on everybody. And we're not just talking real estate, right? 401ks, IRAs. I mean, it is the financial crash of our generation.
Well, and I was going to say, I mean, we were running into that where we would start a deal. By the end of the deal, the house was cheaper. Right. So, like it was happening that quick. So appraisals was the scariest thing ever because you had the banks went from like, I don't know, tell us how much money you need. We'll appraise it at that. To the complete opposite of this ultra conservative, like it was a fear almost with the appraisers because they were so scared to be held accountable by the bank that if they appraised it even remotely too high, but the comps were falling like sacks of sand out of the sky. And so they could figuring out a value in '08, '07, '08, '09 was really, really difficult. And it was very nerve wracking for agents like myself because some of these deals, so think about this, the short sale era.
Yeah.
Right. I cut my teeth in short sales. Oh yeah. These deals would take 6 to 8 months, sometimes longer.
Oh yeah.
To do. From the time you write the purchase agreement to the time that you close, it could be 6 to 8 months. Well, at the rapid decrease, we're losing value. I had to sometimes adjust a purchase agreement because the appraiser from the beginning to the end, it would drop another 10% in value. And so you're having to redo and go back to it, be like, so just kidding. It's actually this now but we would take the appraisal and then the bank was like, well, what are we going to do? We can't argue with an appraiser. It is what it is. Got to go. So
that's a perfect example.
It was it was a wild situation back then. And so, okay, so here I had a loan officer say this to me. This was coming out of, and we're still like, we're going to talk about today here in a little while, but the last handful of years, and we've had what I would call an inventory crisis, the complete opposite.
Yep.
Right. In those days, I explained to people months of inventory is always something that we look at from my side. You understand this as well, which is for anybody listening, what this means is that 6 months of inventory, meaning that if every single buyer on the market bought every single house on the market right away, it would dry up in 6 months. 6 months is a baseline of inventory. That's considered perfectly stable. Buyer and seller, no one's in charge. It's just a flat, stable market. In '08, I think it got above 13. It got close to 15 months of inventory.
That would make sense.
Meaning that it was a massive buyer's market. Everyone needed to sell, but very few buyers were buying or pulling the trigger. Now flip this. Take this coming out of COVID. We at one point had a 0.8, less than half. It was a 3-week. We had a 3-week in supply on the market of houses for sale.
Which is crazy.
3 weeks.
When you say it like that.
Like, talk about the complete opposite. I had a loan officer actually tell me this. Her name's Sheila. She's a very, very good loan officer out in Nevada. And she said, Kevin, I could make the argument that this market is harder than 2008 for loan officers and realtors. She said, because if somebody came into our office and was able to get a mortgage, it wasn't, can we find you a house? It was, all right, here's 100 houses. Which one do you want? That was the hardest part. It was sure for us. But she was like, from a loan officer standpoint, it was easy. She said, the problem we have now, people will come and say, I want a house. Okay, great. This is perfect. Here's this. There's no houses for them to find.
No.
Right? And they're going, well, I want to move up. Well, I'm not going to move until I find the other house, but I'm not going to put my house up for sale. So it becomes this, like the engine just starts to seize up because everyone's scared to put their house on the market because they don't know where they're going to move to.
Yeah. And
she made the argument that she goes, in some way, shapes, and forms, this market's harder. Yeah. What's your opinion on that? Did you experience that I'm not take this year off the table, because this year was a little bit different of a monster than the last couple of years, but I would say, the 3 years before that, I could make an argument that those were some of the tougher years I've seen in my career.
Yeah. You're saying prior to 2020?
Yeah. Prior. Yeah. So no, you got we had the boom that came out of COVID, right? Where it went nuts, right? 2020, 21.
Yep.
but I'm talking
you're
like
saying, yeah, sure.
23, 24,
Yeah.
right? When, that everything got expensive. So prices shot up coming out of COVID. They skyrocketed. And then inventory just went up, gone. No inventory. And everybody got scared because they couldn't find a house. There's that like 2-year pocket that I could make an argument that 2000, I'll say 23, that's a good year of saying it, that 2023, in some ways, it was completely different ways, but in some ways was harder in our profession. It was different challenges, but was harder in some ways. What's your thoughts on that? What was that like for you those years?
Yeah, I would agree. I would think that 2008, at least in my opinion, from a lending standpoint, was by far the tougher year. But I would say it's comparable. And so these are the factors that you have. So just like you said, COVID hits, everybody's essentially stuck at home. Nobody really understands what's going on right now, but I mean, we literally have a pandemic, right? Like it's been announced, airports are shutting down, and all of these new rules and laws that we have to obey with masks and these things, and it creates a state of panic. Well, now that everybody's essentially functioning and working from home, and you're forced to sit in the four walls of your home, and interest rates are now at historical lows, well, it was the common sense move. How long is this going to last for? If I'm going to be home all of the time, I'd like to improve my housing situation. And I mean, I think it even went as far as a lot of people in New York, Chicago, even Detroit execs. Okay, well, I'd rather be in Florida or somewhere warm. And so you had a lot of people that were buying vacation homes, investment properties out in Florida and other states for that matter. But as far as the aftermath of that, every single person that was, let's just say, involved or surrounded by a friend that may have done real estate or a family member or a loan officer, now all of these people want to jump in the pool. Because at the end of the day, I've got a line out the door. I'm at 2.875% on a 30-year fixed.
Free money.
It's banks are at a 90-day turnaround time on just a standard refinance. We, even at one point in time, were up to 60 days. And I would have been with Caliber Home Loans at this day.
Yeah.
And I mean, 60 days, comparatively speaking, it was still a month faster than anybody else was getting it done. But that was the thing, is that consumers or clients, they couldn't get the attention of a loan officer. Everybody was so busy. And then if you're me, you're not ignoring your real estate agents. You've got obviously this housing boom that's going on as well. And we've been around doing this long enough. You realize, like, you can't get caught up on the refinance side of business, ignore your agents, because eventually those rains aren't going to start with a 2, and you're going to need those agents as your business partners to work through the 2022 years.
Yes.
So in a long, convoluted answer, 20 and 21 were absolutely amazing. I would not say it was harder by any stretch than 2008 financial crash was. Following years, obviously, yeah, it got pretty weird very quick there.
23. So think about this from not just the standpoint of not enough inventory. You also have what you just mentioned. I'm at 3%, right? It's hard for me to convince me to have any interest to move if interest rates are 7.
Correct.
It's hard for me to tell a client, if they don't need to, if they just want to tell them it's a good financial decision when interest rates are 2.5 times what their current rate is, right? The cost of the money became so high for so long, coming off of everybody refied. So we would always joke, why would you sell your 3% rate for 7? Why would you? Because that's what it felt like to a lot of people, because it was a little bit of the reality of it. On top of, A, I don't know where I'm going to go because there's nothing for sale. On top of one X factor, which I think you're going to appreciate this one, everybody knows 10 of us. Because the market got so hot, and in the middle of COVID, I will still make this argument. What did every single bartender, server, industry worker, they were sitting at home. They couldn't work in our state for 8 months.
Yep.
And what did they do? They
It's
went,
actually a really good.
well,
Yeah.
I'm going to get a real estate license. I'm going to get a loan. I'm going to become a lender. Flood. So now you have 10 times as many realtors and 10 times as many loan officers flooding into the market. So when most of those people got in the market, they're like, this is amazing. You could walk down the street and find a deal because money was free.
Exactly.
It wasn't tough.
As long as you could answer the phone.
But then, everything twisted and turned, and 2023 came along. Interest rates spiked back up, and everyone went, oh, wait,
It's not that
You
easy.
have to work.
Yeah.
What?
Yeah.
It was amazing how many people I watched that were back at the restaurants, back at the bars.
Yeah.
Again, not that there's anything wrong with that, but
No,
they
not at
came
all.
in and never had anybody take the time to sit down with them and, like you said, teach them not just a crash course, but teach them the longevity model of how do you last in this industry for 20 years,
Yeah.
not 2 years. And that's where I think 23 started weeding people back out. That's why my argument is similar to what happened in 8. 23 did some of the same stuff to our industry just because of the flow of what happened. Now I think we're coming out of that now that we're in 25 coming into 26. So let's touch on that for a second because you've sat with my team and done a very good job, and the two of us have really taken the time to try to just not just educate our own teams, um, you know, and our consumers, but to really be out there and conversational with what we think is going to happen, what we know is happening,
Sure.
and where we think it's going to go. So I believe I stated this quite a few times over the last 30 or 40 days. I believe that we are going to look back. Right now, most people out there look back and say, I wish I bought a house in 2020, 2021. I would have bought it at a 3% interest rate and at 25% cheaper than it is today.
Yeah. At least.
And I get all the time. I just had a text message the other day. Well, when is it going to go down? Prices have to fall. They have to drop. Kevin, they have to. And I said, text right back. I said, absolutely not. I said, I'm happy to get on the phone with you and give you every economic reason why there's no way they will fall.
Yep.
And in fact, they're going to get more expensive. So right now, people look back on coming out of COVID. They look back on 2010 and go, I do. I'm like, gosh, I wish I had the connections and the assets I have now because I would have bought everything. I would have bought Metro Detroit in 2010 if I'd had the money.
Some people did.
Yeah, some people did. They did pretty well. And the guy who owns that company you used to work for did a pretty good job of snatching up the world in 2010.
Yep.
But they had the foresight and they had the financial backing. We look back on those days. We look back on 2020, 21. I believe that next look back is the next 6 months.
Yeah.
So I believe that people are going to look back a year from now, this time next year, and into the year after that. They're going to look back and go, dang it, did it again. I screwed up. I did it again. Because right now there's houses sitting on the market. There's properties available that are still sitting there.
And you can actually negotiate. You can get favorable terms.
How many times have we actually been able to negotiate in super favorable terms for mutual clients where I'm calling you going, yeah, you're not going to believe this, but check this deal out. Where one of the agents on the team calls you and says, hey, we got this deal. It's X amount percentage below asking price. And I got them some concessions and I got them occupant. And we're going, we haven't seen that in a while.
Yeah.
Like there's some opportunities there. Do you think the same thing's going to happen? Do you think people are going to look on this next 6 months down the road and believe that it's a missed opportunity if they don't take advantage?
So absolutely. So what I'm seeing right now, and obviously not in all circumstances, but in quite a few, we're getting appraisals that are coming back much higher than the sales price. I'm even looking at refinances for clients that have purchased, some of them even shorter than a year ago. So there's a couple that I financed a mortgage for in April of this year. They bought out in Ann Arbor, 680 sales price. I'm doing a refinance for a mortgage for them right now, and the appraisal came back a couple of days ago, and it came back at 750. So now that's a rare circumstance, okay? But you're looking at the difference of like, it's not even 7 months since they closed.
Yeah.
And that's obviously a large sales price in a very good area. At the time, they knew that they got a decent deal, but to think like they have to pull comps within the past 3 months, they're not the same comps that would have been used when they acquired the home. So I think right there that's a great example, but it's not just Ann Arbor. I did another loan for a gentleman that purchased in April of 2024, and I financed that mortgage in May of this year, and that was a Chesterfield property they paid $305 for. A year later, the appraisal came back at $350. So
Jeez.
right now, appraisals are just not a concern.
Yeah, but we haven't had a while. It's been a while since we've had to have a conversation about a deal where I've had to call and be like, a little concerned about this one. We're not seeing that right now because all of the values on these properties are extremely substantiated. Yep. It's very easy to do a look back on the comps and go, yep, that makes sense for the most part. 90+% of homes, yeah, if you see a home that's been listed for the last 6 months, it's because the price is jacked up, right? Sure. It's nowhere near where it needs to be, right? Anybody watching this, just so you know, if the home has been for sale for 6 months, it's priced wrong. It's just a fact, right? It's not priced correctly. The market is saying no because of the price on the property, not the house itself, the price on that property.
Yes.
We all know that at the right price, everything sells.
100%.
The right price, because the true definition of value is what a consumer is willing to pay for a product.
Sure.
Right? That's the real definition of value. But I think that what's going to happen, this is my predictor, and this is just, I've been wrong before, but in this situation, I really don't think I'm wrong. I just don't. I think we're going to see what's going to feel slow for the next 4 to 5 months.
Yep.
I believe that November, December, January, February, March,
Yep.
right, coming into what's going to look like the spring market, you're going to have the natural feel of the slowdown of the holidays. You're going to have the natural slowdown that we see sometimes, not always, in Michigan, of a foot of snow.
Yep.
Right. You're going to have people that will make the excuse to not move during that time. People will still move. We'll still do deals. We'll still have people that will come. But the people that come during those 5 months, they are going to be able to purchase homes that this time next year are significantly, it's the story that you just told, significantly higher in value. Because we know interest rates are coming down. They've been coming down. They've been floating the last 30 days, right? They've been kind of doing one of these.
Yeah, I'd really say since
Still unstable the last 30 days.
August is kind of when Powell had foreshadowed that the Fed was going to likely be making a rate cut in September, and that we may have potential rate cuts 2 more by the end of the year. And I would say that's when rates that are going in the right direction. So it's not like brand new.
No,
probably towards the end of August is when this took place.
This has been happening. We've been watching this cycle happen. Where problem we're running into now, what I'm hearing from people is, I'm just going to wait till money gets a little cheaper. I'm going to wait. So this is what people have to remember, right? I will tell it to you guys again. Be careful how long you wait. Be super careful how long you wait, because you can wait too long. And it's not going to happen overnight. We're not going to turn around and all of a sudden prices go, whoop. That's not going to happen. But when interest rates drop, I believe the magic number starts with a 5. When they go sub 6, again, that 6 months of inventory, it's the same thing with interest rates. 6% is, in my opinion, even Steven. The bank and the consumer, no one's got an advantage. When the money goes above 6, 7, 8, 9,
slow down.
Things slow down. The bank is probably asking a little too much of an interest rate. When it goes below, the consumer is to an advantage. So if the consumer gets into the advantage seat where they're at 5.5, let's say 5 3/4, it gets to 5.5. Buyers that have been sitting around for 3 years, 4 years waiting,
They're going to start getting antsy in a good way.
and you want to know what 3% to 5.5% doesn't mean a lot of difference anymore, right? That doesn't hurt nearly as bad
as a 7
or an 8. It's a completely different stance, and people are going to say, I'm getting back in the game now. All of the want tos, the need tos are going to do it. They've been doing it. It's the I want to move for A, B, or C reason. I've been holding out because it got too expensive, i.e. the cost of money got too expensive. But what's going to happen now is everybody waits. That happens. That interest rate goes down. Prices, inventory is going to drop even more than it is now. And we get back down in that low 1 month, 1.5 months of inventory. Guess what starts happening? Bidding wars, more cash to toss stuff. All the stuff that we saw back in 2021.
Yep.
That all that comes back.
So yeah, just to kind of piggyback off of your thoughts there. So you're so dead spot on with what you're saying. This is my thought process. Okay. Anybody that is sitting back waiting for an interest rate to start with a 5 or a 4, maybe we get there. I think there's probably a pretty decent chance. At least the way this administration has been talking about rates, what the plans are.
I'd be shocked if it doesn't go to at least 5.
Absolutely. And I mean, we've been pretty dang close a couple of times, right? So we're almost around, we're dancing right around that low sixes, high fives area to where,
Wait, the day that you call me, like, guess what? 30-year fixed, 5.8. What are the yes?
yep, 100%. So this would be the advice that I have for the consumer that's waiting for that rate until they purchase. Guess what? So is everybody else.
Mhm.
And so the moment in time, let's throw 5.875% out the door. Let's say we get down to the low fives, high fours. That's not impossible, especially on the low fives. We've had interest rates of the fours well before we had a pandemic.
Yeah.
Back in 2016, we had a pretty decent period of time where 30-year rates were in the fours, 15-year fixes were in the twos. Most people didn't realize that. There was a huge spread margin-wise between the 30 and the 15 at that time. And so, in my opinion, what would happen is if interest rates trickle down into, let's even say, low fives, high fours would be amazing. You're going to see people, because let's not take into consideration just the people that purchased homes in 2020 and 21. Let's take into consideration people that bought 19, 18, 17,
The people that didn't take advantage in 21 that waited, oh, I'm going to wait till it goes to zero. I don't know, like that they did. There's people that waited.
Nope, same page, but my mindset or thought process is more along the lines of maybe they didn't need a bigger home. Maybe these the people did not want to downsize. Or maybe these people now have bigger growing families. They want to upsize, but they didn't necessarily purchase home in 20 or 21, but they sure as heck financed their mortgage in the 20 or 21.
Correct.
So it's not just the people that purchased and have these large equity gains, but it's the people that already had homes that didn't purchase during that time that had the low rates. So now you've finally given those people the financial incentive. And I mean, you said it yourself. You said 25%. I think on average it was like 10 and 20 and then maybe 15% and 21. It was like a 25%. Yeah, just everybody.
Overall, over the course of about a year and a half, it was about a 25% value increase.
Yeah, your first time home buyer, 3% down. Conventional, for example, now has over 20% stake in their equity, right?
100%. They have that money sitting in their house, basically banked,
Yep.
ready for their next purchase.
100%. So rates get down to that point. This is who you're fighting against. I'm not going to tell you it's going to be 2021. I just think that was like a perfect storm for, a crazy situation that took place. But I think you're going to feel a portion of it. I mean, not just like a little tickle. Like, I think it's going to get bananas. I really do.
I really believe next year, by the end of the year, to the beginning of, we'll call it end of 26, 27, I think there's a really likely chance that we see a double-digit percentage, 10+% increase in pricing.
I would think so too. I mean, just based on even the examples of people that bought a year ago and what their homes are appraising at now. I mean, that's a pretty big.
So think about that. Proof if the difference of 10%, that's a big difference in purchase price, especially if you're talking $500,000-$600,000.
Oh yeah,
like that's a lot of money. So I've used this phrase for a while now, but it still stands. It makes sense. Marry the house, date the interest rate.
Yeah,
right? You can go out there and get the house now for the right price.
Absolutely.
Over the next 6 months, buy it now.
Yep.
Get it now. You have a decent
interest rate. Semi-permanent. The financing is now.
The financing can change. Again, the Quicken loans, the Rocket mortgages, these companies, they were built on the refi. You touched on it when you came in, right? They've been a purchase company, but they exploded on the refinance.
Oh yeah, absolutely.
These banks are always there for the refinance, right? You can have a customer come to you right now, purchase. You keep an eye on it, and in 6 months, you can refi them for virtually nothing.
Yeah.
Or it doesn't cost them hardly anything. They make up for the cost of the refi sometimes within 2 or 3 months.
Yeah,
right?
absolutely.
It pays for itself. So why on earth would that consumer not do it now and say, all right, so I'm paying a little bit higher in my payment for 6 months, but I'm banking on just historic economics and saying this is what's going to happen. Let's do it, right?
And again, if you don't own a home.
Yeah, and that's why I'm sitting here saying I believe people are going to look back, because we can all look back to multiple times in history when we went, got it. Like, man, I should have taken advantage of that.
Yep.
And I think the next one is at our doorstep. I think the next big boom where people are going to go, wow, I didn't think that was going to happen. I think it's going to happen next year. I really, really do.
Yeah, I think so too. I think that the trajectory right now So Powell did mention that he still has concerns over inflation and unemployment. That made rates go a little bit in the opposite direction, nothing crazy. So we were counting on another decrease in rates potentially in December. That's not a foreseen guarantee at this point in time. I do know that more than likely he will probably be retiring in March.
Yep.
And like this administration or not getting political, but the man seems to follow and do what he says he's going to do. And it has been a hot topic. He's been pushing on Powell to drop rates, and Powell in his own way.
The current administration wants rates. We know that they're not directly affected, but we also know they're going to follow leader.
That's my point. I think that's what's going to happen. I think they're going to put somebody in that is probably a little bit more influenced by the current administration and what they are expecting, as far as, interest rates in the market to do. And I think that you're going to see interest rates continue to come down. And as a result, just like you said, I think we're going to have a mini 2021 all over again.
Yep.
Now, as to how long it actually takes for that all to progress, I don't know. Interest rates, they can move so quickly. I mean, just the smallest, piece of news can be a spook, and they can go down, they can go up. It's such an unpredictable thing. And, even some of the best rate predictors in our market have been completely wrong for the past couple of years. But I would say, I think there's a good chance that, and I think even the forecast is supposed to be low sixes for next year. But I honestly, I think there's a good chance we get into the fives. I think that's what it will take to really make this market start moving.
The market will go, I think, once we get into fives, that's when we see the floodgates really start to move.
And not like 2021. It's not going to be a line of people out the door.
It's not going to be overnight.
No.
Right? It's going to be a little bit of a slow increase, but it's going to start happening. And there's a chance, if it starts happening, you could see a little bit of a flood, because people will start to see prices go up and go, uh-oh, hurry, go.
Yep.
And that's when things can be. We have to keep our eye on inventory, because I will be able to know it based on inventory. I'll be able to know it based on interest rates and inventory, what I think is going to happen. But the people that are telling me, what would you say to somebody? Curiously, I'll give you my take after, but what would you say to somebody that calls you and says, well, I don't want to buy yet. I'm going to wait until prices go down? Because I've heard that one a lot over the last couple of years. And like I said, I just heard it the other day. What are you saying as someone who has watched house values? You've seen appraisals, you've seen all this stuff for 20 plus years. What would you say to that person?
I think that person just needs to have more education. They're just not making any more land is probably the common phrase that I would say in a situation like that. Yep. All of these new generation of people that are graduating college, and as far as housing is concerned, yes, we definitely have more inventory than we did pre-COVID, but that's not really to say much, is all it boils down to. The person that is thinking about waiting, refer them back to 2022, 2023, 2024, and now 2025. Things haven't gotten any cheaper. They've gotten more expensive. In my opinion, if you're the person that is waiting for prices to come down, it's never going to happen.
They're going to be waiting.
Yeah, and I would just look at real estate statistically, right? 2008 was an anomaly. That was just hopefully a once in a lifetime occurrence of a financial crash of markets because of irresponsible lending. And let's call it what it is. That's what it was.
And people don't understand
that can't happen again.
They need to watch. If they think it's going to go down, okay, go watch The Big Short. It does a really good job of explaining what happened in the financial markets that caused that crisis.
And why we would never allow that.
And why it's never going to happen again, because you could sit here and attest all those bad loans, all those terrible ARMs, all those things that came out, because we still have ARMs, but they're more responsible.
100%.
Right? But it was all the bad lending that caused that bubble to explode. It wasn't that prices were so high that it had to explode.
No.
It was the irresponsibility of the financial markets that caused it. And that has not happened since.
Correct. Mortgage-backed securities were supposed to be the golden standard of investments, right? Like, you just can't lose. And companies were just getting more and more aggressive with how they were manufacturing this money. And so, yes, you could go stated income, stated assets, but it carried a higher margin, right? The fees were higher, the rate was higher. And these investors are ultimately just charging margin for what they think the liability of this is. Okay. And still today, we have similar products, not quite stated income, stated assets, but we do have portfolio products where a client can use bank statements to qualify with their income if they're self employed. And fundamentally, the point is they make sense now. Like we still review some form of income, we still review assets. We don't just write it down on a piece of paper and say, this is what I have.
These are verified information.
Yes.
It's not, I'll take your word for it.
Precisely.
Of course I'm going to believe you.
We do verify enough information that the investor is making a sound business decision by allowing that mortgage to be essentially closed upon. But the meat and potatoes of everything that we still do today is agency insured, so conventional, HUD insured, which is FHA and VA. And you have to have pay stubs, you have to have W-2s. We do look at ratios. So the way that we qualify a mortgage today versus the way that we qualify mortgages in 2008 previous, it's two different worlds. Hence, that's why you will not see that kind of a housing crash based on those type of circumstances ever again.
And what you'll have to see, what people have to understand too, this is locally driven. For example, I have had people already say to me, well, look at what's happened in Florida. Their prices have been going down.
Yeah.
That was based on insurance. And once I explained to them, well, understand why. Because we've had multiple, not one, not two, multiple devastating hurricanes that have hit Florida. The insurance companies have either said, we're not insuring in Florida anymore, or if we do, you are going to pay massive insurance premiums.
State Farm pull out.
Yeah.
I mean,
They pulled out of the state. So when you have people coming in that their insurance costs, and what we have to remember, a lot of Florida's fixed income.
Yep.
And these people have been living there, and yeah, they may have paid a smaller amount for their house and watched it go wow through the roof in value. The reason they're coming back down now is because a lot of those people are saying, well, if you're quadrupling, 5+ Xing my insurance, my income, right, what I have now, my fixed income doesn't feel right there. So you want to know what starts to look really nice to them? Scottsdale, Arizona.
Yep.
All right. There's other places that have beautiful weather that start to feel pretty good.
Yep.
Where people go, maybe I want to go over there where I can get a normal insurance cost and not have my house wiped out from under me every other year. And that's what's happening in Florida.
Yep.
So we also have to remember, take a look at, this is my other argument to people is, it may happen in some other cities because there's some cities that I do feel they're inflationary as far as their housing values. Take a look at California. But if you look at every major metro area, and we are a major metro area, and Detroit is without a doubt still on the comeback.
We are undervalued.
We are
still
massively undervalued. If you take a look at the suburbs of Detroit, Detroit is a huge metro area, and you take a look at the cost of living in Metro Detroit, it is massively cheaper than any metro area in the country.
Yep.
We are still super cheap. Take a look at what you can get in the suburbs of Chicago compared to here.
Oh yeah.
It's twice the price in the suburbs of Chicago. I mean, there are very few metro areas that I know of, at least I don't none that I've really been to that are as large as Detroit, where the housing is cheaper.
Yep. That's 100% accurate. And people don't understand. They look at the prices now compared to what the prices were back then. And in their brain, right, it's like, well, wow, this is so much higher. I could have bought this house for half of what they're selling it for if I would have purchased it 10 years ago or whatever the case is. Right?
They're so stuck still in the rearview mirror thinking, well, it's okay. 2010 prices are coming back.
Yeah.
2010 prices are never coming back.
Yeah.
They're gone forever. They're a glimpse in history. A certain amount of people took advantage of them, but they're never, ever coming back. We are in a new reality of the cost of housing.
Yo.
And I'm glad that you said it because I think the same way. I don't see a world where it comes down. I just don't.
No.
I don't see how that happens.
You'll have certain states for certain. I do not think Michigan is one of them. Florida, you had brought up a great point, but see, another thing just to give some education around that, you could be retirement age on Social Security and a small fixed pension. You could own your home free and clear. You've got your property taxes. You've got your homeowner insurance. So that's your real estate obligation. Well, you said 5 times. I've seen situations where clients have gone from a $1,200 a year insurance policy up to north of $10,000. So think about
Well,
that.
that's catastrophic if you're on a fixed income.
100%. Because if you have a fixed amount of income and it's always worked and you always have lived off of this, and now you've spent years budgeting with your groceries and, anything and everything that we need for everyday life outside of housing. And now all of a sudden, the largest chunk of your expenditure happens to go to insurance. You can't stay. Even if you're not in that situation, even if you're, just making a great salary. Maybe you're making a six-figure salary and you're a business exec and you're doing very well. And let's say you bought a $500,000 home in Florida, 5, 6, 7 years ago. I mean, that insurance policy is no different. I mean, maybe they were paying 3 or 4,000 a year. Maybe that's up to 15, 20 now is the point. So it literally affects
Well,
everybody.
and think about this as well. We lose sight of the fact that there's a big chunk of Florida, especially when you get up the coastlines,
Yeah.
um, that are heavily investor owned.
Yeah.
Airbnbs are everywhere. Well, you want to know what destroys the profit on an Airbnb?
Insurance.
Insurance and taxes
Taxes.
are a huge indicator because your margin can be completely lost. So that investor that purchased that home that now has, 5 to 10x their insurance costs goes, I can't do this.
Right.
And they know they can only charge so much from a rental standpoint. The asset starts to feel way too risky. And so they've started divesting in places like Florida, which has caused, again, a lot of inventory because of the market. Inventory has to come on the market for pricing to go down. You have to have plus 6 months. When you go over 6 months of inventory, that's when people get competitive. Oh, my neighbor, I'm trying to sell for 600, when my neighborhood just put up for 550. Uh-oh, I have to consider 550. That's how pricing goes down. Until inventory goes through the roof in any area, and it has to be there for a while. It's not like a 2-day thing. This is a 3+ month rise effect on inventory. You're not going to see prices come down until that. And we have not gotten anywhere close to that kind of inventory margin. Now people are negotiable because you get people that need to move.
Yep.
And if you're for sale right now, you need to move, and everyone's waiting on interest rates to come down and not acting. That seller may say, well, yeah, I may take a little bit of a haircut because I need to move.
Sure.
If I need to sell this property out, I need to.
Well, when we say haircut too, it could be a haircut like a legitimate haircut for a home they bought within the past 2 years or something like that. But it also could be a haircut versus what they could have sold it for yesterday versus today, and they've owned for 10 or 15 years. So it's not necessarily that people are selling this and losing their asses.
No one's losing money. We're not in the conversation where people are losing money. There's a perception of lost money, but it's just a perception off of what they've seen the last 3 years and what they believe their house could have been now.
Yep.
And so it's still all perception. So for us, we're just trying to advise people more practically on, hey, look, your house is probably not going to sell in 2 days, and it's probably not going to sell for, 30 grand over your asking price. Those days are not here right now, right? And that's not the market we're in. So us, like you, we're just trying to constantly educate. It's one of the things that I've appreciated most about working with you is you're so good at educating the consumer. You're so good at having conversations with the consumer to educate them on what they should and should not do and how they should be a little strategic. Not only are you, a tough loan officer, meaning that you're a grinder, like you get the job done, period, get the job done, but you have a really good way of making sure that you are actually taking care of the customer the right way, which I really appreciate.
Yeah, no, I appreciate you saying that. And same thing goes for you and your team. I mean, your clients absolutely love you. You guys provide value. We make a great team working together. And I think to summarize this whole discussion in regards to like where real estate's going, I think you're spot on. And I think that all of the agents that have hunkered down and made it through these couple of years that have been really tough, I think there's going to be some light at the end of this tunnel. And I do think it's going to be next year. I think we're going to have a crazy spring. I think that we're going to start out, believe it or not, towards the end of March.
Yep. I think it's me March too. That's my indicator. I think March is when it starts to get a little wild for us.
100%. I think
So you tell the agents on the team, like, you just got to hold on. It's gonna feel real lean here for the next 4 months, but
enjoy the holidays,
it's on its way.
spend time with the family, if you some indoor golf, whatever your guilty pleasure is. And just repair, get
Never
us.
played indoor golf. What's it like?
It's
That's a huge one.
from what I gather, friends, it's all a riot nowadays.
So before we finish, I want to ask you one last question, because both of us are in, and we'll have to have you back on because I want to get into some general business growth conversations with you. Today, I felt like it was important for us to talk about, you know, your career path, but also just what's going on in our industry right now. But um, our team has been in a big growth pattern this year. The second half of our year, we've added a lot of agents, new people, building through culture, building through, just getting the right people in the room. I know you're doing some of that too. I know you've been in a growth phase and we've had conversations about, okay, Kevin, like for us, what's next? So give me the what's next. What's the vision for Team Taveggia? Where are you wanting to go? What's your indicator on what you believe is your next level in this business? 20 plus years, you've got to be thinking next level or something. What is that? What's that piece?
Yeah, no, it's a great question because this is on my mind daily. So I found the light and I got into coaching. A little arrogant to think that coaching couldn't help me after doing this for 19, 20 years. I've been in coaching now for a year and a half, and it's probably the best thing I've done for my career. Period. Since just signing on the dotted line and accepting the offer when I got back into mortgage back in June of 2004. And what coaching is teaching me is that as an individual who is married with a son, um, I need to be able to learn how to lean, delegate, and request support. And so I have always had and had been by my side to help me out. Now I am developing a team that is comprised of, let's say I want a licensed loan officer that's going to help me on the front end. I need to have somebody on the back end that is handling everything from application to close, for example. I need someone in the middle directing traffic. And the idea is that in order for me to grow my business, I have to be able to delegate and I have to be able to trust. And it's a very hard thing for me to let go of. And I know that you know exactly what I'm talking about because you obviously coach and you're in coaching too.
And I've been through the same struggle of learning how to hand things off.
Yes.
Especially things that I'm used to doing myself.
Precise.
Of handing them to somebody. And I had a coach once tell me that if you hand something off and they do it 80% as well as you do, 80% is good enough.
Yes.
They're not going to do it 100% like you would, but 80% almost always is really, really good.
So you've shared that with me before, and that literally is like, I don't want to say like my mantra, but that was something that actually made my brain like be able to say, okay, I comprehend this. He's right. So what I'm ultimately saying is that I can't expect someone to be 100% of me.
Mm-hmm.
There's a handful of me. There's a handful of you.
We're different.
We're a little
different. We are a little bit different. We're super weird.
Yeah.
Because most people wouldn't do what we've done for 20 years.
No.
If they knew what it took, if they actually understood what it takes to do what we do, most people would be like, nah, I'm out.
Absolutely.
I ain't doing that. They don't understand the late nights. They don't understand the pressure.
The sacrifice, family.
It's personal. It's a lot. Sure. A lot to do things the way we do. But helping people and teaching people and building people that can do it close.
Yeah.
Is important.
100%. So your thought process is, so you've got so many minutes in an hour, so many hours in a day, and you can only dedicate so much of your life to professional work, right? And so how do you duplicate your efforts? Well, you can't recreate yourself. You can't have a mirror image that's going to do 100% of things the way that you do them, the way that you do them. So just like you had said, if you can ultimately train someone to even do 70% of what you are capable of. So that ultimately means you're probably going to have a couple more fires, right? You're going to have some other issues that you're going to have to deal with. There's going to be growing pains to this. But let's just throw out a figure. Let's say I do 10 million in fundings in a month. That's great for an individual, right? That's a really, really big month in the lending world. Well, if I can train 3 guys to do 7 million in a month, right? And I mean, this is very basic, but now I've got 21 million. Which number do you want? Do you want to close the 10 million or the 21 million? I'd rather close the 21 million. By the way, that's outlandish. I don't ever expect to close 21 million in a month. We've gotten close in COVID type deal with that attitude. Well, maybe one day with a big enough team, absolutely. But just using it for simple numbers' sake. So when you actually, not realizing it, you coached me and it made me finally understand like, okay, as much as I would want, I would literally have to eat, breathe, live office. I wouldn't be able to do anything else. And although it's great,
Be lame.
yeah, exactly. I wouldn't be able to golf. I wouldn't be able to.
Want to hang out with you anymore.
Nobody would.
You wouldn't be able to. It would
I
have
was
to be
just,
you.
I would be living, yeah, at my office. I
Like
just,
boring. James is boring.
and so my idea where I'm going with, my team is that now I am starting to spend time developing my team members so that I can teach them how to take, let's just say, some of the more remedial tasks off of my plate, but like the finished product, what I ultimately want it to be, I'm doing this with you every week. I am out and about. I am meeting new agents. I am meeting clients. I am doing everything that allows me to articulate and bring new business in the door. I'm not doing data entry. I am not running 3 different payment scenarios for 3 different homes that a client's going to look at.
Can train that.
And these are all very important things, but just like you said, that is something that I need to learn. Like, hey, it's okay if Joe tells the client this is what the principal, interest, taxes, and insurance are, versus you having to pull out your calculator and do it. Like, they can handle this. You've got to trust them. And that has been, getting over that hump has been the challenge, but I'm working on it. I have plans to grow this real big.
Love it. And one of the things that I've told people that have come on with us and different people, especially in the administrative roles, right? That they're not sure how to push the buttons yet, and they're learning how to push the buttons. I've said, just start pushing buttons. It'll be okay. Like, we're going to figure this out. I'm going to coach you through it. I'm going to work you through it. I'm going to train you through it as best as I can. But just always know, I want you to make decisions. I want decision makers on my team. As long as you don't steal and you don't lie, I can fix anything.
Yep.
Just don't do those 2 things.
Break a plate.
Yeah, it's fine. There's nothing that we can't fix, that we can't pick up off the floor and make it okay.
Yep.
Just don't steal and don't lie.
Yeah.
Because those are 2 things that are hard to recover from.
100%.
So
reputational wise, and obviously for the client as well.
those have long-term
Adverse
problems.
effects.
But everything else, small mistakes are small mistakes. We are not perfect. And you want to know what? You learn through mistakes.
Yeah.
That's how people remember to do things right the next time, because they screwed up.
Oh,
and
yeah.
so not, teaching your people that it's okay to make mistakes, but you just have to go do is very important. We have to go do. So I am super excited. I think the next couple of years, 3, 4, 5 years of growth for both of us is going to be fun. As this market, like we talked about today, pops off, it's going to be fun to work through that. I'm sure me and you will have super stressful days where we're calling and be like, dude, I have been going crazy hard. I need a minute. Let's just go chill. Like, those days are going to happen. But it's fun to have someone like you that I don't just consider a business partner, but I consider a very, very good friend, a very dear friend.
Thanks, man.
That I get to live this with and walk this with and work this with. It's been a real pleasure. I know my team loves you dearly.
I love you.
We've really had a good time.
These are easy to use to love, to be fair. You're just good people. You work hard. We do good business. And yeah, I'm glad that it's worked out the way it has too, man. It's been a great relationship.
It's been fun. Well, thank you for coming on today. It's been a blast, guys. As always, thank you for listening today. And as always, go out there and be yourself. Everybody, I need you to be yourself, because the world needs you to be yourself. Have a good day. Bye, guys.